The four basic market structures are perfect competition, monopolistic competition, monopoly, and oligopoly. The notes have a table that identifies how they differ. Some crucial aspects of market structure are the number of firms in the industry, the influence of an individual firm over price, the extent to which products are differentiated within the industry, whether advertising is prevalent or extensive, whether entering the market is easy or difficult, and maybe some examples. Perfect competition has many firms and no product differentiation. The combination of these two factors, a large number of firms and lack of product differentiation, means that no individual firm can determine its price. Each firm must take the market price as given and decide how much to sell facing that price. In fact, perfect competition is the underlying model for supply and demand that you saw in Econ 210. Since all products are the same, there's no reason to advertise. In fact, each firm can sell as little or as much as it wants at the current price, so there's no reason to advertise. Another key important characteristic of perfect competition is that entry into the market is easy. Now, there are no great examples, there are no perfect examples of perfect competition. Some good ones are truck farming. Truck farming refers to farmers with small trucks who transport their crops to markets, which might be other farmers or wholesale buyers in their small trucks. We'll quit there. Monopolistic competition. Again, has many sellers, but now there's a fair amount of product differentiation. Each firm is selling something that's a little different from its competitors within the market. This differentiation gives each seller some limited amount of influence over price for its particular product. It can raise price and not lose all of its sales. It'll lose price, but will not dominate the market if it drops price a little bit. The differentiation means that there's going to be a reason for advertising. Monopolistic competition also has the characteristic, it shares the characteristics with perfect competition, that entry is easy, which some examples, lots of examples of monopolistic competition. Most retail markets in which you and I are shoppers are monopolistically competitive. Gasoline stations in Richmond, women's clothing stores in Richmond. There's a lot of both types of stores. They're not all the same. And there's lots of, so there's product differentiation, but also it's fairly easy to start a new clothing store. Gas stations are a little more difficult, but entry is not particularly difficult in either of these markets. Oligopoly. Oligopoly, there's a few sellers, which means that each seller has some influence over price. Differentiation actually might be none, might be a lot. Advertising might be some, might be none. Entry is usually going to be difficult in an oligopoly, which is why there's only a few sellers. Many manufacturing industries are oligopolies. Most people view now the manufacturing market for automobiles as oligopolistic. You've got GM and Ford and Toyota and Nissan. Who am I missing? The big players, you know. Volkswagen, they maybe get smaller with their recent problems. But you've got, 10 firms, maybe 20 firms that totally dominate the market for automobiles. How many firms make aluminum in the United States? Answer is not very many. I think it's 2 or 3. The world's got a few more, but again, there's a small number of sellers in the aluminum manufacturing market. Pure monopoly is when we have one seller, which means that seller has total or complete control over the price. The demand it faces is the demand for the product. Only one product means there's no differentiation. Monopolies may advertise, so I'm not entirely happy with everything on this chart. But the advertising will be more demand increasing advertising than it would be advertising to get customers to move from another seller, because there are no other sellers. Monopolies are going to be associated with barriers to entry that make new entry almost impossible. An example of this might be water, which we mean by water, we mean city water sold by a public utility company. You might view a drug company selling a drug with a patent, a monopoly. That'd be particularly true if this drug has no close substitutes. The market structure of a firm has several implications. And firms in perfect competition have no market power. They can sell as little or as much as they want without affecting the market price. Firms in monopolistic competition and monopolies have market power. They can increase price by reducing the amount offered for sale and must lower price to increase the quantity demanded when demand is constant. Oligopolists are interdependent. Action taken by one firm affect both its own profits and the profits earned by the other firms in the market. Oligopolistic firms typically face a tension between rivalry and cooperation. Typically, the sum of the profits in the industry increases when firms cooperate. This means that each firm in the market could gain when all firms cooperate. Now, legal restrictions may make illegal both cooperation and side payments that may be necessary for all firms to gain. On the other hand, an individual firm is usually able to increase its individual profit if it defects from a cooperative solution. Here's an example. Firms in an oligopoly all earn higher profits when they all charge the monopoly price than when they all charge the competitive price. Firm A earns more profits when it charges the competitive price and all other firms charge the monopoly price than when it charges the monopoly price. So all firms have an incentive to cooperate. They all make more profit, but firm A has an incentive to charge the lower price if it's the only firm charging the lower price. Fifth implication. Entry and exit drive rates of return to whatever is normal in the long run in perfect and monopolistic competition. Freedom of entry and exit will drive profit to the normal rate in the long run. Both perfect and monopolistic competition have no barriers to entry. Therefore, economic theory says in the long run, they will earn only the normal rate of return. Barriers to entry may allow firms to earn abnormally high rates of return in the long run in oligopoly and monopoly. So this analysis suggests that if you really want to earn long rates of return that are high in the long run, you need to be thinking about barriers to entry. You need to either find an industry with barriers or figure out a way to create them if you're in there.